All right, today we are diving into a real head-scratcher. We're looking at a company called NBY. Now, on the surface, this looks like any other penny stock business, but the market has somehow valued it at over $1 billion. How on earth does that happen? Let's break it down.
So, this is the big question, right? This is the mystery we're here to solve. How can a company pulling in less than $1 million in revenue have a price tag of over $1.3 billion? The math just doesn't seem to math, you know? But there is an answer, and it's kind of hiding in plain sight. I mean, just look at this disconnect. It's wild. On one hand, you have a market cap, the total value of the company, at about $1.34 billion. And on the other, over 9 months, they've made just over $500,000 in revenue. This is clearly not your typical growth story. Okay, so to untangle this mess, you've got to do one thing first. Follow the money. So for Section 1, we're going to uncover the financials. Let's take a peek inside the company's bank account and see what's actually happening day to day. So according to their last big official filing back on September 30th, 2025, NYBA had about $2.3 million cash in the bank. Okay, that's our starting point. It's a real solid number we can work with.
But here's the thing. That cash is not just sitting there. It's flying out the door. Based on their losses, we can figure out they are burning through something like $740,000 every single month. That's just to keep the lights on.
You do the quick math on that, and yikes. Their cash would have only lasted about 3 more months from that date. Now, to be fair, they did raise another $6 million later, which definitely helps kick the can down the road. But it doesn't change the basic fact that the business itself just isn't making money. Which brings us right back to square one. If the business is losing money hand over fist and its sales are tiny, where in the world is this billion-dollar valuation coming from? Clearly, the answer isn't in their operations. And that brings us to Section 2, because this is where the real story is. It's not about revenue, it's about the shares. There's a hidden tsunami of new shares getting ready to hit, and it's going to completely change the entire company. Now, to get what's happening, you need to understand a term called stock dilution. It sounds technical, but it's super simple. Imagine you have a pizza cut into 4 big slices. Your piece is huge, right? Well, dilution is when the company keeps adding more and more slices to that same pizza. All of a sudden, your slice is just a tiny sliver. That's dilution. So let's look at the before picture. As of that September 30th filing, NBY officially had just over 6 million shares out there. A pretty small, manageable number. But now, look at what the market is actually trading on today. The big financial data services, the ones that feed your brokerage app, are showing a share count of around 126 million. Wait, what? Where did an extra 120 million shares come from? Just look at the difference here. It's absolutely staggering. On the left, that little bar is the official share count from a few months ago. On the right, that's the giant, fully diluted number the market is really looking at. We're talking about a more than 20-fold increase. It's practically a different company. So are these shares just appearing out of thin air? Nope. It's all in the fine print. The company made deals to convert different kinds of special stock, called Series D and Series E, into regular common stock. That's where about 120 million shares come from. Then you add in some warrants, and there's another 5 million or so. This wasn't a surprise. It was a planned financial maneuver. So this brings us to Section 3, a whole new ownership reality. Because when you introduce that many new shares, it doesn't just make each share worth less, it completely changes who's actually in control of the company. This quote from the source analysis just nails it. It says NBY's market cap is only meaningful if you base it on this new, fully diluted reality. That old number of 6 million shares, you might as well just throw it out. It's irrelevant now. So what does this new reality look like? Check this out. Once all these preferred shares are converted, the new investors who hold them are going to control about 95% of the entire company. And the original shareholders, they're left holding the bag with the remaining 5%. So who are these new investors? Well, the filings point to a structure led by an investor named David Lazar. He's the one who's positioned to take over both the economic and the voting control of NBY once all of this is finalized. Okay. Wow. So what does this all mean for someone just looking at this stock? Let's get into our final section, the investor checklist, and just boil it all down to the key takeaways. All right, here are the big red flags to watch for. Number 1,
obviously, is the massive dilution we've been talking about. It's the biggest risk. 2, the business fundamentals are just plain weak. 3, the company has the power to do a reverse stock split, which can sometimes be a bad sign. And lastly, the cost to bet against the stock is super high, which can cause these crazy volatile price swings. Now, on the other side, what could actually drive the future here? Well, everything hangs on stockholder approval. Key votes have to happen to make all this final. But the real potential game changer is what management does next. They've basically said they plan to use this company, this corporate shell, to go out and buy or merge with a real operating business. That's the end game here. And that brings us to the most important takeaway from this whole thing. When you're valuing any company, you have to ask yourself this one question. Are you looking at the business, its products, its sales, its profits, or are you looking at the balance sheet, the share structure, the financial engineering, the potential for a deal? For NBY, the answer couldn't be clearer. It's all about the balance sheet.